Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Doug McKnight. Doug has over 30 years experience in capital markets. He specializes in maximizing portfolio performance while maintaining balanced risk versus yield relationships. And in just a minute, we're going to speak with Doug about the future of commercial real estate market in 2023. And but first, a couple of reminders. If you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Doug McKnight. Welcome to CRE PN Radio.
Thank you, Darren. Thank you for having me.
Well, I'm looking forward to our conversation, but before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Sure. I'm Doug McKnight. I am the president and a partner at Reef Holdings. We're based in Dallas, Texas. My background specifically really is on the institutional capital market side. In fact, Black Monday was my first day on the bottom floor, so I'm dating myself. But we formed our company, Reef Holdings, coming out of the financial crisis back in 2010. We felt that we would have RTC2. For those of your listeners that remember the 80s, we went through the painful experience with the RTC. We thought we would just, have a repeat. Fortunately, that did not take place. But out of that grew a thesis here at Reef that I'm happy to get into with you about the Reef story. But that's really my background, and what's unique about it is myself and my three partners, we all have unique backgrounds that we've brought into this company, which I think has contributed to our success thus far.
Got it. So if we could maybe just back up here a second, the marketplace up to this point, money's been pretty free flowing. There's been a lot of stimulus money that always kind of is, bastardizes the market based on, it's not necessarily, just capital chasing deals. There's another element there. If you were to characterize where we've been, how would you best describe the market up to this point?
Well, Darren, if you couldn't make money in real estate over the past decade, then you're in the wrong business. It's been easy, from a standpoint of cost of capital and margins. Obviously, we are entering into, and have been for latter part of 22 and certainly going into 23, more challenging environment that we can certainly discuss in more detail. But up until this point, the areas of the market that we specialize in, and I will will say that we as a company, we focus on what I like to call middle America. So we are, for the most part, in each of our platforms that we can get into, we're focusing on really your working families in your middle America, affordable housing, affordable vacations. And we believe that that area of our economy, not only is it the largest demographic in our economy, but it's the most resilient. Now, up until this point, resiliency hasn't been as big of a worry because all types of real estate have been quite resilient. Of course, going through COVID, we had some areas of commercial real estate that weren't as resilient as others. What would those be? That would be the hospitality industry with hotels. That would be your more of your luxury residential, luxury high-rise multifamily. Some of those really, took a ding. But other parts of commercial real estate, whether it be industrial or whether it be more affordable housing or more affordable vacations, really did quite well, during the pandemic. But as we move forward, resiliency to recessionary pressures, higher interest rates, et cetera, that's going to be more of a challenge. And that's certainly going to separate those that are, more experienced and have gone through market cycles before and sort of understand the landscape better before we even get to that point. Those are the ones that are probably going to perform better.
Gotcha. As far as asset classes that you guys focus on, I heard you mention a couple there. Do you have a couple lanes you stay in, or are you agnostic to asset class, or how are you set up?
No, we're not agnostic. We are, coming back to that thesis I just mentioned of middle America. We own today approximately 16,000 multifamily units across the South, Southeast, Sun Belt areas of the country. These are mostly in your secondary and tertiary markets. We were in this space back in 14, 15, 16, when institutional capital just wasn't there. So we enjoy very wide margins, and we really, sort of hung out in that space when there really wasn't a lot of capital chasing it. And that's one part of our company, one of our platforms, I like to call it, that we're still very much involved with today. I think we got up to about 21,000 units at one point, but over the last 18 months or so, given market conditions, we have had some reversions where we have exited some deals and we've done quite well. Like I said earlier, if you haven't been able to, hit or exceed, your projections in this market that we've been in with the interest rate environment, you're probably in the wrong business. Another platform is beachfront hospitality and resorts. And what do I mean by that? I mean older outside corridor hotels, motels in iconic locations on beaches, whether it be the Gulf Coast, the West Coast of Central and Southern Florida, or the Eastern, Southern Atlantic coastal areas. We own hotels, motels in those markets. During COVID, those markets were what became known as drive-to destinations, and those particular assets did quite well. We also own a resort in St. Simon's Island called Sea Palms that was also given its location and as being a drive-to destination, But what is in common with all of those assets is the affordability, but yet similar experience as something maybe down the road that's, going to cost 700 or 800 a night, where 200, 250, maybe 300 in the highest season a night. Same beach, same experience. And so, again, speaking to Middle America, another platform that we have is what we call Reef Communities, and that is more of master plan development, where we will be delivering single family homes for sale, single family homes for rent, which is known as BTR, built to rent, and also multifamily, highly amenitized town centers, schools, parks, walking trails, lazy rivers, pickleball, all the things that are really, desired in today's world from a lifestyle standpoint. When you get home from your day at work, you want to be able to have all those experiences really within walking distance. So it's basically building small towns. We own a little over 3,000 acres just south of Dallas-Fort Worth that we're going to be doing this, and we're going through the entitlement stages right now. We have another 3,000 plus acres between Austin and San Antonio. So we're very excited about that. And again, COVID really put a spotlight on the urban versus suburban, I guess you would call it desirability, if you will. And so that is going to be a very, very large part of our company's future going forward. The fourth platform is extended stay hospitality, where, again, serving Middle America workforce for the most part, whether it's traveling nurses, whether it's construction workers, or whether it's people that are going to need to be somewhere for 2 or 3 weeks or a month or more in a particular city for their work. Those hotels were not as geographically limited in scope. We're building those all over the country. But again, very resilient and very much centered toward Middle America. The fifth platform, which is the platform that I was just late to because of meetings all morning, is we're going to be rolling out RV communities. The RV space here in the United States absolutely exploded during COVID, but it was really very much a growing market even before COVID. But again, the overriding thesis throughout all of that is really serving Middle America and being in very resilient types of real estate. We don't own luxury high-rise apartments in downtown Dallas, which is what I'm looking at behind me. We don't own Four Seasons and Ritz-Carltons. We try to keep our focus and our mission aligned in order to be able to have that resiliency as it relates to the yield versus risk relationship.
Got it. So if I understand correctly, basically the clientele you serve is the focus, and then the different properties, whether it be the multifamily or the resort or the other properties. The common thread is that class of Middle America, kind of just the middle class kind of thing. The people, something that's affordable, whether it be a place to live or a place to vacation, kind of thing. Am I hearing?
Yes, that's a fair assessment of our thesis here at Reef.
Oh, I like it. I think there's definitely a benefit in focusing on something. I mean, you get to know that, that client, that prospect, what their wants are, what their needs are, and be able to cater to them. I'm certain that would put you in a better position than you're a little bit in this, a little bit in that, kind of this, kind of that kind of thing. And definitely probably some leverage too. Um, I'm curious on the, you mentioned the hotels, the older motels, hotels kind of properties that you guys have. Do you have a particular brand that you operate those under, or are they boutique uh, based on the area, or how do you set those up?
Yes, they are boutique. In fact, we have our own brand. It's called Beachside Resorts. Uh, what we have found that in the locations that we're in, the approach to being unique and boutique is actually a benefit. Uh, we do, from a technology standpoint and from a back office support platform standpoint, it's very much of an institutional approach, because your management, your operations is obviously part of the secret sauce. But in terms of the experience for the guest at those properties, they are experiencing something unique. As I said, I'll give you an example. We have 2 beachfront properties in Panama City Beach. Okay, we are on 30A, but when I say 30A, most of your listeners are probably thinking Seaside or Rosemary Beach or Alice Beach, because it is the same highway. It's on a different part of the highway, but it's the same beach. So, our residents are going to come in and they're going to have, and of course, they're probably going to drive, right? Given the geographical pull that the Panhandle has from the southern areas of the country, but they're going to have the same beach experience, and they're going to pay a fraction of what they're going to pay on the other side of 38. I'll use that as an example. And that's the type of demographic that we serve.
Gotcha. So we have or we've covered kind of the, how easy it was to make money in real estate. We've got a picture of the types of properties that you operate in. Let's talk about going forward here in 2023.
Right.
What do you see? First of all, if you have a crystal ball, or I mean, I hear projections from this to that, and it seems like there's a pretty wide spectrum of what people are expecting. What's your sense of, how this is going to play out in 2023?
I have no idea.
That's fair.
Yeah,
What are you preparing for?
I don't have a crystal ball. I wish I could find one, but given my experience in business, every time you do that, you're always wrong,
Yep.
or you're oftentimes wrong. I believe instead what you have to do, and what we strive to do every day, is that we try to weigh and measure our risk and measure that against our mission and our purpose. And if those are aligned, then it should not matter to any great extent the economic environment that you're in. So if you're in affordability, for example, and you know that that your residents or your guests, depending upon the type product, is going to need a place to live or want a place to go to a vacation, then it all boils down to affordability from that standpoint, from the guest or resident experience standpoint, from the capitalization standpoint, which is really at the core of your question. Going into a rising interest rate environment, coupled uniquely in the market we're in now, if you couple a rising interest rate environment with not as much of a commensurate increase in in cap rates, that it creates an interesting dynamic in commercial real estate. Typically, if you've got a rising interest rate environment, prices adjust, cap rates increase, and you're able to maintain some spread. Maybe it's not as much spread. What we've been experiencing and what I believe we will experience if I did have that crystal ball is that compression. And, you know, you're getting to a point now where you are going to have to be dealing with negative leverage. And what I mean by that is if your borrowing rates are higher than your cap rates, then you're going into a transaction negatively arbitrage. So that is a very, very interesting dynamic that we have in the current market environment. And you have to not only be very strategic in the location, in the product type, but you have to be very, very keen and lasered in on the operational side. The operational side within commercial real estate, regardless of the product type, really is what separates the successes from the failures. And like I said, over the last many, many years, you know, if you weren't as efficient on the operating side of an asset, given the interest rate environment and given the overall market economy, you've done okay. But now going into this that we're faced with, it's going to be a challenge. And us here at Reef, just speaking for our company, we continue to be buyers of commercial real estate. We continue to be buyers of multifamily. And like I said, over the last 15, 18 months, we've had some very successful exits out of assets that basically reached their holding period. And it was time to have an exit event for us and for our investors. But going forward, we're going to be very, very keen on making sure, as I mentioned, that the mission and the purpose is aligned with the risk. And if you keep those factors aligned, then you should be okay. The most powerful thing in real estate is being able to say no. And, you know, when you're able to say no and you're able to say, you know what, that's not a fit, that's what, you know, separates a lot of the successes from the failures. The markets are going to adjust. They always do. You know, you see it right now in multifamily rents, for example. You're finally starting to see a little bit of a breakdown in terms of the rent growth. So that's a good example of if you are having, or if you're starting to see some cracks in rent growth, then that's going to be evident in your cap rates. And you're going to get back to more of a normal, more of a positive arbitrage that's going to allow more deals to get done. So we're going through a transitional period right now. You know, do I know how many times the Fed's going to bump? I have no idea. My gut tells me that we could possibly be lower rate environment at the end of 23 than we are at the start of 23. But with that said, if you were to say, okay, Doug, are you betting your company's capital stacks in all of your assets on that assumption? No, I'm still looking at fixed rate debt on my leverage because I am not wanting to make that bet or that gamble as it relates to where we'll be in a year or two, because it's very hard to tell. We are coming out of an environment that really we've never seen as it relates to a booming economy, a very structured and safe and fiscally sound housing market, unlike what happened back in the crisis, and then being slammed with a pandemic that was a true black swan event, if you will. Uh, Not to mention the geopolitical climate, everything else that we're involved in right now, that's making it hard to get things into a normal type of environment. So it is unique, but at the end of the day, you're still dealing with inflationary pressures, you're still dealing with interest rates, you're still dealing with labor, housing, all the variables that go into a market cycle, whether that market's good or whether that market's bad. You're still going through that. Maybe we got here for different reasons, or maybe we got here for unique reasons, but we're still here. So you got to manage through it. And that's what we plan to do here.
Yeah, no, I think the transition's always kind of the challenge, and I believe there's opportunities in every market. It's whether or not they're recognizable based on what you're used to, what you're expecting versus where it develops, and I believe that a lot of times with these financial crises, uh, the powers that be try and plug the hole so that doesn't happen again.
Right.
So but there's an expectation, I think, a lot of times that people think, well, it happened like this last time, so that's what we're looking for this time. When the reality is it comes from some other direction because that hole's been plugged.
That's right.
But I think it's human nature that there's this expectation of it's going to replay itself. And I think more than anything is that it's that the dynamics in play, the marketplace is just not settled right now, and that's the kind of, as we work through it, like you were saying, that how long will it be, or who knows what exactly it'll be. It sounds like you're committed to being conservative with your estimates, and also the ability to say no. I can't underscore that enough, is the power of that, as opposed to having to do something that's not as favorable. I wanted to ask you, you mentioned, exiting a couple of multifamily deals. It sounded like at one point you're up to like $2,100. Now you're down around like 1,600, if I understood correctly. Um, are you doing those through syndication, or what's your investment structure model there? And
Sure. Yes. I'm happy to walk through that. Uh, as I said, we at one point back many months ago, we owned as many as 22,000 multifamily units. We have had a number of successful exits. I believe we've probably exited a little over $1 billion in AUM during that time frame, just in the multifamily sector or platform. I believe we've averaged in the mid 20s in terms of IRR, and we've averaged around a 2x multiple on equity on those exits. Most all of them had really gone through their hold cycle of 3 to 4 years. So it was really in the normal course of business. However, it was in a very good market, right? We're coming out of a market before COVID and to a certain extent during COVID, where there was what I like to call stupid capital out there overpaying for assets. But to answer your other part of your question, uh, from a capital structure standpoint, we probably own today 80 or 90 different assets. Each of those assets are in their own LLC. Each of those have got unique debt partners. Sometimes those assets are combined into portfolios in order to be acquired. And occasionally it'll be a one-off or a two-off, if you will. But from a capital structure standpoint here at Reeve, we do not have a fund, an equity fund or a debt fund in-house. We don't have capital that we have to deploy. I sort of look at that as a cart pulling a horse. You tend to, at times, make mistakes when you have to get your capital out. There's nothing wrong with that model. From the institutional world, needing to find sponsors and GPs like REEF, that's their model. That model works for them because they're looking for the opportunities that the sponsors like REEF go out and find, and then they team up their capital. For us, we want to be a whole lot more opportunistic and nimble in our decision making, to make sure that we're not being forced to do something. So with that said, our capital structures really typically look like the following. You'll have a debt partner, a third-party debt partner, whether that's Fannie Mae and Freddie Mac on the multifamily side, whether that is a commercial bank, whether that is a REIT, or whatever type of lender fits that particular asset or portfolio. Then you will layer in your equity. That equity, for us, typically, we will have a preferred equity partner that'll be a third-party institutional partner. Whether that is a fund or a REIT or private equity. And then we also layer in our own equity. So we have here at REEF a very robust, what I like to call retail equity platform, where we have well over 2,000 accredited investors that invest directly with REEF in REEF sponsored deals. That allows us, again, as I said earlier, it allows us to be very nimble and very opportunistic. And it also aligns everyone's interests because we're investing along with our other capital partners. And ultimately, we do well after they do well or when they do well. And we don't have any institutional capital partners at the corporate level. Basically, our company is owned by 4 families, myself and 3 other partners and their families. We're privately held, and we like to keep that simple.
Gotcha. With the changing environment, how do you see investors in their expectations? Are they receptive to the story? Or are they resistant? Are they saying, I'm gonna wait this one out? Or what's been or how have they received the?
I think that the smart investor today, in today's environment, they're going to be cautious and they're going to be a little bit more hesitant to venture into a new type of asset or into a new type of structure, or maybe even into a new sponsor that they don't have experience with. And I think that is being proven because, like I said, we are in a more challenging real estate environment than we have been. And I think that understanding the mission and the purpose for why that asset is being acquired and why me as an investor am considering putting my money into it, does all that line up? And does the projections and the business plan, the business thesis for that particular investment, does it make sense? And then where can you make mistakes? Where can you maybe not do it exactly the way you think you can do it and still be successful? That is where a company like us, that's why we like to be in that middle America space, because there is still some room there for markets to move and for some dynamics to get a little bit out of whack, whether it's debt rates, cap rates, or whatever the dynamic is. But as investors in today's market, or I'll speak for our investors for the most part continue to programmatically invest with us. But I think one reason for that is they are not seeing us try to venture into new spaces and new territories to go get yield, but just for the purpose of going to get yield. We are staying within our lanes. We're staying in the types of assets that fit our thesis. And so far, our investors are continuing to invest alongside us. But I think in the environment we're in, the environment we're probably headed into, whether it's near term or whether it may get longer than what my gut tells me, I think the prudent thing to do is for any investor is to do their homework, understand the sponsor, understand the asset, understand what the business plan is, and diversify. And I think diversity, whether it's asset type or whether it's geographics, that's going to be very important, because real estate, when you get into a tight environment, when you get into a more constrictive environment, then real estate becomes less commoditized. It's very easy for real estate to be more commoditized in a very favorable market. But in today's market, it just is not the case, if that makes sense.
Yeah, no, and that's a perfect little segue. I was going to ask you, how do you see sellers' expectations, as we kind of transition into this marketplace from where we've been?
Well, obviously we're buyers and sellers,
right?
And we prefer to be in a position, obviously, where we don't have to sell. And that is the position that we're in with our assets that we own and manage. I believe today we're a little bit over $5 billion in AUM. And we enjoy the flexibility of being able to, since we are a vertically integrated company, everything's under one roof, whether it's acquisitions, underwriting, due diligence, dispositions, capital markets, property management, asset management, legal, accounting, all the different components of a real estate transaction from the start to the finish is under one roof here. So you really don't have opposing forces that are making you make a decision that maybe you otherwise wouldn't have. And our investor base has the same thesis, and they understand that that's the way we operate. I'm just able to speak for us. So as a potential seller, we are going to do, from a fiduciary standpoint, what is best for our investors. And one of the ways to be able to do that is to, as you said, be conservative in the way that you put together your capital stack. I like to say, for example, that debt is an asset. That sounds weird, sounds backwards. But from a standpoint of a capital structure, your debt component, instead of it being a means to an end, it actually is an asset as part of that structure, because your debt is going to be worth more or less depending upon your interest rate environment when it comes time to exit that asset. So when you're selling that asset, if you have a very attractive capital structure and debt structure, oftentimes that asset can be worth more money. And sometimes when you go back to the cart pulling the horse analogy, sometimes you have sellers, especially in the environment we're in now, that are essentially being forced to sell, whether it's because of constraints within their capital stack, whether it is a mandate with their fund that they have to exit in a certain period of time. So we are seeing that. But those that can be nimble, those that can be flexible, and those that are in good quality assets that are opting to not sell, I believe that'll end up being the better situation. But with that said, there's still very good opportunities in the marketplace from a buyer and a seller standpoint. like I said, we've exited, over $1 billion over the last 18 months. We've acquired over $2 billion in the last 18, 24 months. So we still remain net buyers as a company, even though we have taken opportunities to exit.
No, I think that's all, great perspective and kind of, again, speaks to your philosophy and the power of the ability to say no. The sellers that can't say no are, going to have to take what they can get to get out of their situation. Whereas if you do have some debt with some runway, you've got a good operating property. You don't necessarily have to get out right now. So why would you? Unless you had some silly offer, which I'm guessing a lot of the silly offers are not happening right now. Hey, Doug, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's 3 strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be clients, investors, interest rates, the political environment, however you choose to identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Doug McKnight, what is the biggest risk?
Well, when I think of risk, just in general, I think of what I said earlier. I think of what is my mission? What is my purpose? What's the end game? And then I try to measure the risk that's involved in achieving that. And I really, at the core, that's what risk is, right? Risk reward. It's another way to say it. We are quite risk adverse. Now, let's face it, real estate is a risky investment. Now, that dirt is going to be worth something, right? It's not like it goes to zero. But real estate, of course, over the years, it's been considered an alternative asset. It's really become more of a mainstream asset over the last, 7 or 8, 9 years. But it's still a risky investment, and it's an illiquid investment. If you are an investor in the real estate itself versus maybe a REIT stock, then you're investing in something that not only has risk, but it has no liquidity, right? So, those are variables that you have to weigh as an investor. As an owner operator, there is potential risk in every single element of the lifespan of owning that asset. From the day that you begin your underwriting and your due diligence, if you're not conservative enough, if you're not realistic enough, if you're not understanding the market or the data that you're being provided by the seller, whatever the case may be, if you're not doing that properly, that is a big risk if you underwrite the asset incorrectly. There's an expression that you always want to make money on the buy, right? And then when during the acquisition process, you have a risk of not putting the capital stack together properly, which is what we've already talked about. What kind of debt do I want? Do I want variable debt? Do I want fixed rate debt? If I'm going to do floating rate debt, variable debt, am I going to go buy rate caps in order to protect that exposure to interest rates? Certainly, with the rise in interest rates, that is certainly an element. And then during the lifespan of ownership of that asset, have you managed it properly? what's the risk of mismanagement? And that is a huge risk. It's also, and it's not a risk that can really be measured. I like to call the operational side is the secret sauce, because you can buy an asset right. You can have a phenomenal capital structure, but you can manage it right into the ground. So that is a big element of risk. From an asset management standpoint, that is where insurance comes into play. We often joke that we're probably overinsured in every asset we own. But I will tell you an interesting story. So we own a hotel in Pensacola Beach down on the Panhandle, Florida. And it was one of those 70s, 80s vintage outside corridor hotel that we basically took offline. We gutted it and we revitalized it. We put in lazy river. We put in all these different really cool features. We put a restaurant, tiki bar out on the beach. We did all these things to this property, and it was performing amazingly well until the hurricane came along. Okay. Well, the hurricane hit the property, but really visually it didn't do any damage. Now it messed up the pool and lazy river, brought all the sand in, brought all the rain and wind in, knocked a little bit off the roof, but really no big deal, we thought. But given the quality of the insurance that we had on the property, our inspectors and adjusters come in and to their credit, they found moisture within the walls, and they deemed it that it needed to be much more extensively repaired. Well, given that it is back in the 70s and 80s prior to current building code, the bottom part of that hotel was below sea level. Well, you can't rebuild below sea level, right? So the short part of the long story is that we completely tore down that entire property, and we're now in the process of finalizing a high rise. It's going to be an amazing property. We've already returned our equity to our investors. We're still going to own it. It's going to be newer, fresher, and it's going to be a whole lot more valuable. And the good news is not only did no one get hurt, that's the best part, but our investors and us, we have a new asset. And if we did not have the proper type of insurance in that situation, everybody would have failed. And that speaks, I believe, to the focus that has to be put on insurance, because oftentimes, and of course it depends on your lender and it depends on what you're required to go out and do, but sometimes you'll see situations where assets are not properly insured, whether it's a fire at an apartment community or whether it's a hurricane at a hotel or etc. So we are a big believer in being properly insured. I'm a big fan of insurance.
One of the few, but for the right reasons. I appreciate that example there, because that's what insurance is. It's meant to get you back and be a capital source to keep your business going in that. So it sounds like it worked well for you.
No one needs insurance until they do.
Yeah. Nobody wants it until they need
That's
it.
right.
So
That's right. So they don't have it.
Yeah. Hey, Doug, where can the listeners go if they'd like to learn more or connect with you?
Well, they can certainly visit our website at reef.com. By the way, that's spelled RREAF. So a little bit of an unusual spelling. The way we spell it goes back to some of the predecessor companies that bore the roots of the company, but it's RREAF.com. You can contact me through the website. You certainly email me. It's just simply doug@reef.com. Feel free to call us in Dallas anytime. Feel free to come by and visit us. We love it when people just show up and want to learn more about our company. So I'm not hard to get.
Awesome. Well, Doug, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
All right, Darren, it's been my pleasure. Thank you, and thank you to all of your listeners.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.